Uber just printed $52 billion in revenue and $10 billion in profit, so why does this look like the top? Picture this, a Taylor Swift concert just ended. 70,000 people are pouring out of the stadium at once. It's raining. Everyone opens Uber at the same moment. Surge pricing kicks in, 3x, 4x, maybe more. And here's the thing, a human driver sitting 20 minutes away does the math. By the time they fight through that traffic, the surge might already be fading. Their time has a cost. So a lot of them just don't come. Now imagine 500 Waymos have been parked quietly outside that stadium for the last 45 minutes. No driver calculating opportunity cost. No one deciding it's not worth the trip. They absorb the entire crowd at a flat rate. That one scenario, played out at scale, is what this video is about. Welcome back. Today we're building the bear case on Uber, not because the company is badly run. Because it isn't, but because there's a structural argument that the market may be seriously underpricing. We're going to walk through the unit economics, the competitive dynamics, and what the next 5 years could actually look like for a business that has always been asset light in a world that's about to get very, very physical. As always, nothing here is financial advice. This is purely an analytical framework, and you should do your own research before making any investment decisions. With that said, let's start with the numbers because they do look almost perfect right now. And that's exactly what makes this interesting. Let's go back to the initial scenario. A Taylor Swift concert just ended. 70,000 people pour into the street, it's raining, and everyone opens Uber at the same moment. The surge multiplier spikes to 3x. But a human driver who's already 20 minutes away does the math. His time is worth roughly $23 an hour in earnings. So he skips the ping and heads somewhere closer. Meanwhile, 500 Waymos have been sitting in a parking structure close to the stadium exit for the past 45 minutes. Their cost to wait is about 13 cents an hour each. They don't have mortgages. They don't have better options. They were pre-positioned before the last song ended, and they'll absorb that crowd in minutes. Now, before we get into what that asymmetry actually means for investors, we need to be honest about what Uber's financials actually look like right now. Because the numbers are genuinely impressive. Full year 2025, $52 billion in revenue, up 20% from the year before. Net income of just over $10 billion. A net margin of 19%, which is remarkable for a business operating across 70 countries. Free cash flow of $9.8 billion. And 15 billion trips over the course of the year. Every single one of those numbers would have seemed like a fantasy 5 years ago, when Uber was burning cash and the profitability question was still wide open. So the question isn't whether this is a good business, it clearly is. The question is whether 2025 represents a permanent earning power baseline, or whether it represents the peak. And the bull case for Uber isn't just, the numbers are big, it's actually more nuanced than that. Start with the valuation. Uber trades at roughly 15.9 times earnings. That's a meaningful discount to pure software companies, which often trade at 30 to 40 times. So even if you believe some margin pressure is coming, the argument goes that it's already priced in. Then there's Uber One, 46 million subscribers, growing at over 50% a year. That's a loyalty layer that creates real friction against switching. Add to that the Waymo partnership in Atlanta and Austin, which is being framed as validation. The idea that AV operators actually need Uber's demand network to drive utilization while their own fleets are still too small to go it alone. And finally, the international angle. Large parts of Asia and Latin America are 5 to 7 years behind the US on autonomous vehicle deployment. That's a long runway. None of this is irrational. So where does the bear case actually come from? The bear case begins with a question about Uber's most valuable asset and whether it's actually a vulnerability in disguise. Uber's take rate is roughly 40 to 42 cents on every dollar of fare. That's the cut Uber extracts for connecting a rider to a driver. Now think about what that number looks like from the other side of the table. If you're Waymo or Tesla, and you have your own app and your own cars, that 40% is not a service fee, it's a direct booking discount you can offer to every rider who switches. Hotels figured this out about a decade ago. Marriott, Hilton, and others started offering 5 to 10% discounts for booking directly, bypassing Expedia and Booking.com. That campaign worked. It clawed back meaningful margin from the aggregators. The difference here is that Uber's take rate is 4 times larger than a hotel OTA commission. That makes the direct booking incentive 4 times more powerful. Tesla and Waymo don't even need to undercut Uber on price. They just need to offer a discount that's funded entirely by the margin they're currently handing over. Tesla and Waymo don't even need to undercut Uber on price. They just need to offer a discount that's funded entirely by the margin they're currently handing over. And that's exactly what the early data shows is happening. Tesla's autonomous test rides in San Francisco averaged $8.17 per trip. Uber's average in the same market was $17.47. That's not a minor pricing gap, that's a consumer who pays more than twice as much to ride with a human. Waymo has closed the gap more gradually, trading at roughly 12.7% above Uber's price today, down from a 30 to 40% premium just a year ago. If that trend holds, and there's no structural reason it shouldn't, Waymo reaches price parity somewhere around 2027. At that point, the question isn't whether consumers will switch. It's whether there's any reason left not to. The price data tells you where this is going. The driver earnings data tells you it's already started. In markets where autonomous vehicles are actively operating, San Francisco, Los Angeles, Phoenix, human driver trips per hour fell 5.3% in Q4 2025. Nationally, the same figure was 2.6%. That's not noise. That's a measurable, geography-specific divergence that tracks almost perfectly with where AV fleets are densest. Driver earnings in Los Angeles dropped 3.7% year over year. San Francisco was down 1.7%. Phoenix was down 0.4%, and Phoenix only got meaningful AV coverage partway through the year. These are small numbers right now, and the bulls are right to note that. But in system dynamics, early edge erosion is almost always the leading indicator. The aggregator model doesn't collapse in the center first, it frays at the margins in exactly the markets where you'd predict it to. There's a persistent assumption in how people think about this transition, that Google, Tesla, and Amazon will eventually decide the operational complexity isn't worth it. That they'll look at cleaning vomit out of car interiors and managing depot real estate and just write Uber a check instead. It's a reasonable instinct. But the historical record doesn't support it at all. Amazon has spent over $340 billion building U.S. logistics infrastructure, warehouses, last-mile delivery networks, its own cargo airline. It could have paid FedEx and UPS that money in perpetuity. It didn't. Tesla has constructed more than 75,000 supercharger stalls globally. That is a decade of painstaking, unglamorous physical infrastructure work, done specifically because owning the charging layer meant owning the customer relationship. These are companies with the capital and the patience to absorb operational pain for years if the long-term prize is owning the transaction. A 40% take rate on every mobility dollar in America is exactly that kind of prize. Even if you accept that AV operators will try to pull riders off Uber, you might assume they need to build a competing app first, something with Uber's brand recognition and 202 million monthly users. That assumption misses something important. Google Maps already handles more than 1 billion navigation sessions every month. Tesla's in-car operating system is the default interface for every driver and passenger in the vehicle. Amazon Prime has 200 million subscribers who are conditioned to start every purchase inside Amazon's ecosystem. Each of these platforms is a direct-to-consumer channel that already exists, already has engagement, and never required a single user to download anything new. If your Waymo is summoned through Google Maps turn-by-turn navigation, Uber never gets a ping. If Tesla integrates ride-hailing natively into the dashboard, there's no app to open. The aggregator doesn't get disrupted in a dramatic moment. It simply stops being the first screen a consumer sees. So Uber's management saw this coming. In 2024, they announced a $1.25 billion investment in Rivian, targeting 50,000 R2 robotaxis on the Uber platform by 2031. And on the surface, that sounds like a smart hedge. But look at what they're actually admitting. By committing capital to build their own fleet, they're acknowledging that AV operators may not need them as a distribution partner indefinitely. The Rivian deal is management's clearest signal yet that supply starvation is a real risk, not a theoretical one. The problem is what fleet ownership does to the business model underneath. You're adding roughly $2.5 billion in vehicle capital expenditure, around $500 million a year in depreciation, $300 million a year in commercial insurance, and over $130 million annually in depot real estate. That's not an asset-light software company anymore. That's a logistics utility that happens to have a good app. And that transformation, from software platform to fleet operator, is where the valuation math gets genuinely uncomfortable. Right now, Wall Street prices Uber like a tech platform. Software platforms with recurring revenue and high margins tend to trade around 14 times forward EBITDA. That's the multiple Uber currently enjoys. Fleet operators, companies like Avis or Hertz that own, maintain, and depreciate physical vehicles, trade closer to 8 times EBITDA. On the same $10 billion in EBITDA, those two multiples produce very different outcomes. At 14 times, you get roughly $140 billion in enterprise value. At 8 times, you get roughly $80 billion. That's about $60 billion in enterprise value that disappears, not because the business stopped generating cash, but because the market reassessed what kind of business it is. Against a current market cap of around $156 billion, that re-rating implies somewhere in the range of 40 to 50% equity value destruction. The underlying cash flows don't have to collapse. The multiple does, and that's enough. This is what makes the situation structurally difficult to escape. Uber faces two paths, and neither one preserves the current valuation. Path 1, stay asset light. Keep the software model, keep the high multiple, and rely on AV operators as supply partners. The risk there is that once AV fleet density in major metros reaches a critical threshold, enough vehicles to reliably serve demand without Uber's consumer funnel, those operators have every incentive to offer direct booking discounts and route around the 40% take rate entirely. Supply doesn't disappear overnight. It just slowly migrates to a channel that pays Uber nothing. Path 2, own the fleet. Invest the capital, control the supply, and compete directly with AV operators. The risk there is that Wall Street looks at the balance sheet and reprices the stock accordingly, from a software multiple to a fleet multiple. On top of that, Uber then has to directly compete with the best logistical and software companies in the world with deeper pockets than Uber can even come close to. So where does that leave the valuation? The current price assumes that neither path becomes necessary. The bear case is simply that one of them does. There's one more layer worth examining, and it's easy to overlook because the headline numbers look so strong. Uber's current ratio, the ratio of current assets to current liabilities, sits at just 1.14. For context, a current ratio above 2 is generally considered comfortable for a company with significant capital commitments ahead. At 1.14, there's not much buffer. Now layer on what happens through the late 2020s. Fleet CapEx obligations from the Rivian deal begin ramping. Take rate pressure from AV operators starts compressing revenue per trip, and both of those forces arrive at roughly the same time. The $9.8 billion in annual free cash flow is a real and meaningful strength. The bulls are right about that. But free cash flow that's simultaneously funding share buybacks, servicing $12 billion in total debt, and financing a 50,000 vehicle fleet build-out stretches in several directions at once. The cushion is thinner than the income statement suggests. Now, the bear case laid out here is not a certainty, and it's worth being honest about that. Uber's international footprint is a genuine cushion. Asia and Latin America lag US AV deployment by 5 to 7 years, which means the demand-side moat in those markets stays intact well into the early 2030s. That's real revenue, real growth, and real time to adapt. A single high-profile AV safety incident, the kind that triggers regulatory freezes in multiple cities, could push the direct booking tipping point back by 2 or 3 years. And Uber One's 46 million subscribers aren't nothing. Switching to a native Waymo app requires a behavioral change, and behavioral change is slow. So the bear case isn't Uber collapses, it's a race against a clock. And Uber has $9.8 billion in annual free cash flow to keep buying time. The bull case buys time, but time is the operative word. The aggregator model doesn't collapse the moment Waymo adds its 1,000th vehicle, it survives as long as AV fleet density stays subcritical. Below a certain threshold, AV operators still need Uber's demand network to keep utilization rates high enough to justify the capital deployed. But somewhere between 2028 and 2030, in the major US metros, that calculus flips. When Waymo or Tesla can fill a car in under 4 minutes without Uber's app, the 40% take rate stops being a toll they have to pay and starts being an easy margin to reclaim. That's the tipping point, not a headline, not a product launch, just a quiet density threshold that gets crossed. And once it's crossed in San Francisco and Los Angeles, the economics cascade to every other city in the network. So where does that leave the valuation? Uber has built something genuinely impressive. $52 billion in revenue, $10 billion in net income, 15 billion annual trips. None of that is fabricated. The moat is real. The question is whether the moat is permanent or whether it's a toll road that its biggest tenants are quietly paving around. The bear case isn't necessarily that Uber disappears overnight. It's that Uber slowly becomes a different business, more capital intensive, more operationally complex, and structurally lower margin, while the stock still trades as if that transformation never happens, or that Uber slowly fades away until it gets bought out or goes bankrupt. Either way, it's a stock I would not want to be in. The 2028 to 2030 window is the timeline worth watching. If Uber locks in durable AV partnership economics or builds subscription moats that stick before domestic fleet density crosses that threshold, there is a slim chance they can make it through. If it doesn't, 2025 may look, in hindsight, like peak Aggregator. That's the full case. Uber built something genuinely remarkable, a global logistics network running on other people's cars and other people's time. The efficiency of that model is real. The profitability is real. But the thing that made it efficient is the same thing that makes it vulnerable. It doesn't own the assets. When the assets get cheaper, smarter, and available at scale from players who have already accepted decades of physical operational pain, Think Amazon, think Tesla, think Waymo. The aggregator's leverage starts to compress. Not overnight, probably not even in the next 2 years. But the 2028 to 2030 window is closer than most valuations seem to reflect. So the question worth sitting with isn't whether Uber survives. It probably does, in some form. The question is what multiple it deserves when Wall Street has to decide whether it's a software company or a fleet operator. Those are very different businesses. And right now, it's being priced like the former, while quietly becoming the latter. If you have a different read on how this plays out, especially on the regulatory timeline or Uber's ability to run its own fleet profitably, I'd genuinely like to hear it in the comments. This is the kind of thesis that gets stress tested by pushback, and the bull case has real merit. Drop your thoughts below, subscribe if you want more breakdowns like this one, and I'll see you in the next video.